Hey everyone, welcome back to Corporate Decoder, the place where we dissect corporate filings so you don't have to. Today we're diving into a report from Smart Sand, a company that, despite its name, doesn't sell sunscreen but something crucial to the oil and gas industry. Let's see if their year was as smooth as well sand. So this report is dated March 3, 2025, and it's a Form 8K, which is basically a current report companies file to announce major events. Right off the bat, it looks like we are getting an update on their financials, specifically earnings for the fourth quarter and the entire year that ended in December 2024. Earnings reports give investors and the public insight into how a company is performing. Did they make money? Did they lose money? And where is it all coming from? Smart Sand released a press release about their fourth quarter and full year earnings. We can find the full release as an exhibit. This is pretty standard. Companies usually put out a press release to highlight the key points before or at the same time as filing the official report. It is important to note that while this information is being shared, it won't be held to the same standard as other documents, meaning there is less legal liability attached to it. It is more of a snapshot than a complete portrait. Scrolling down, we see the exhibit, a press release covering the year. Jumping into the press release, we get to see the highlights of the fourth quarter of 2024. Let's focus on the key numbers and what they tell us. Smart Sand, Inc. produces northern white raw frac sand, which is used by the oil and gas industry to hydraulically fracture shale formations, helping oil and natural gas to flow more freely. So their performance is closely tied to the activity in the oil and gas sector. First, revenue. They reported that revenue increased 33% to almost $72 million compared to roughly $54 million for the same period last year. That's a pretty significant jump. This likely means they sold more sand and potentially at better prices. A boost in revenue is almost always a positive signal. Net income is also up. The company reported a net income of $5.6 million. In the same quarter last year, they lost money, so it looks like they turned things around. Adjusted EBITDA, or earnings before interest, taxes, depreciation, and amortization, jumped 92% to $17.8 million. Adjusted EBITDA is often used to compare companies in the same industry because it strips out some of the accounting and financial decisions that can make direct comparisons difficult. A big increase here suggests improved efficiency and profitability in their operations. Finally, cash on hand. Smart Sand had $36.2 million in cash at the end of December. Having a healthy cash balance gives a company flexibility to invest in growth, make acquisitions, or weather economic downturns. Now, let's zoom out and look at the full year results. These will give us a broader picture of Smart Sand's performance over the past 12 months. Total revenue increased 19% to $252.4 million. This shows sustained growth throughout the year, not just in the fourth quarter. Growing revenue year over year is a good sign of increasing demand or market share. Net income for the year was $17.6 million, a big swing from a loss of $15.6 million the previous year. This suggests that the company successfully managed its costs and operations to become profitable. Their adjusted EBITDA was nearly $58 million, up almost 50% from the prior year. Again, this points to better operational efficiency and profitability. So what does the company say about these numbers and what they plan to do next? According to the press release, the company's financial results in 2024 demonstrate the success of their strategy. The CEO notes that they are in the process of reactivating their second dry plant, which would double production capacity by the third quarter of 2025. Investing in increasing production capacity often signals confidence in future demand. The company also refinanced its revolving credit facility, which they expect will reduce their borrowing costs in the future. Lower borrowing costs can improve profitability and free up cash for other investments. For the first quarter of 2025, they expect to sell between 600,000 and 650,000 tons of sand. Providing this kind of guidance helps investors understand what to expect in the near term. They also anticipate capital expenditures of $11 to $13 million. Capital expenditures are investments in things like property, plant, and equipment, which can drive future growth. Finally, they announced a new long-term supply agreement. Securing long-term contracts provides revenue visibility and stability. It is important to understand what non-GAAP financial measures are before relying on them. These are alternative calculations of earnings and profit that are not calculated in accordance to standard accounting rules. Adjusted EBITDA as a non-GAAP measure should be seen as supplemental to the official numbers. The company provides a reconciliation of net income to adjusted EBITDA. This reconciliation helps investors see how the company arrived at its adjusted EBITDA figure by starting with net income and adding back things like interest, taxes, depreciation, and amortization. So, what's the story here? Smart Sand had a pretty good year. Revenue and profits are up, they are expanding capacity, reducing costs, and securing long-term contracts. The company's financial position seems to be strengthening with improved profitability and cash flow. Their success is closely tied to the health of the oil and gas industry, so broader trends in that sector will heavily impact their performance. However, companies like Smart Sand are always vulnerable to shifts in energy prices, drilling activity, and technological advancements in fracking techniques. As the oil and gas industry evolves, Smart Sand will need to continue adapting to stay competitive. Overall, Smart Sand appears to be on a positive trajectory. They are capitalizing on opportunities in the oil and gas sector. The company's focus on expanding capacity and securing long-term contracts suggests they are optimistic about future demand for their products. However, investors should keep a close eye on trends in the energy market and the company's ability to manage its costs and maintain its competitive edge. Thanks for watching Corporate Decoder. If you found this breakdown helpful, give us a like, drop a comment, and don't forget to subscribe for more deep dives into the world of corporate filings. See you next time.